Okay, good evening. I wanted to get this CONY out because I know it's been a nail biter. I can't believe that we didn't just break on out, but I think the markets are nervous. Um, Bitcoin sustained itself at the breakout level, and so did Coinbase, barely, right? We were up a tiny bit, so the 225 is the beginning of the breakout. We just need to probably consolidate. So let's jump in and talk about everything. So let me pull up May. I tried to color code these tabs so when you have old synthetics and things, it's easier to find. So if you notice my color coding, that is, and I put them all together so I can just, not that you care about the setup that much, but I'll bore you once in a while. Okay, so 225.78, we moved up 0.26 on coin, the underlying, and we moved up 0.75, so we tripled the upside movement, right? Doesn't mean a lot. Now, Steve, Red Sox Steve, great question. And I'm sure a lot of you guys want to know these kind of things. So when I get to payments today, I'm just, and a little bit when I go into the weeklies that are hurting us, I'm going to go into even more detail and just try and get you guys so you comprehend it. Sometimes I don't update something or I don't do it. And I'm also going to go ahead and knock out I made it once, but I never submitted it, just like a detail of exactly how all the EOMax funds work that do single stocks, right? Because like in Ulti, they actually buy a bunch of stocks and write true covered calls. But that's the exception, not the rule. All of the other ones pretty much do the synthetics, and although WiMAX just simply owns all of the funds, right? So they collect the distributions, and then WiMag just owns a Magnificent Seven. But all of the other single stock funds all play the synthetic and the weekly call game. So I just want to get you guys dialed in to how that works. All right, so moving over here, we didn't have any trades today. But the share count went up, and it went up substantially again, right? So it went 325 increase the day before yesterday, and today, or yesterday on Monday, it went up 325. Today, it went up 375, right? So they continue to have people buying in the fund. And clearly, I would say between this and Tesla, they're the two most popular funds from what I can see. Nvidia's up there also, but you know, Tesla hasn't performed very well. I think it's on a bounce now, and it could bounce a little bit longer for anybody that owns that. But I'm more short-term bullish, mid-term bearish, long-term bullish on Tesla. So I just haven't touched it personally and don't plan to for a while. Okay, so enough of that. And they didn't, you know, they're keeping that cash close. They didn't deploy it. I think they felt like they had enough going. So let's go and look at our weekly. So here's what's going on, and a great question, Steve. So a lot of it was centered around, can they buy back these weekly calls? Yeah, they can buy them back at any point in time, right? But they almost never would. You know, when they write them on a Friday typically, and every once in a while they'll write one on Thursday for the following week on Friday, and they get 6 days, right? But in general, the way these options work, I'm just going to talk about options in general, but it certainly applies to when you sell a call. There's two components that dictate what the price is, right? Well, first off, you always determine everything by the strike, right? And then how much that strike has to do with how far away. So these guys consistently want to look at the market, say it's on Friday, and they're going to write next Friday. Then they want to get, and they know roughly, oh, okay, well, if I go up 5% out of the money, right, 5% higher than it's currently trading, I can get a couple bucks, right? So they do a bunch of contracts, they take that couple of dollars, and in the case of this scenario, it's $7 million that we can collect. Well, that $7 million isn't what it used to be, because nowadays, right, we've got 20 million that we've won so far on synthetics, or sorry, on short calls, weeklies. But that includes the 7 million they paid us last week, which is totally in jeopardy, right? So what does all of that represent altogether? Only 91 cents in the fund, right? So, but without confusing just how they work. So I answered Steve's question with a lot of detail. The other thing that makes these unique, if you're an option trader even out there and you've never done yield max, you have to be aware that most of all their option trading is done in what's known as the flex options marketplace, right? They still go to the same marketplace, but where they access it and in their particular rules within flex is different. The big key difference is what they call settlement. Instead of being an American branded settlement, I had one guy ask me one time, well, geez, does that mean that they're trading in Europe? Is that illegal? Or how can an American? It had nothing to do with them being in Europe. It's just referred to as European rules in flex. And what that means is you can never be assigned the stock. Well, if you have a losing trade, you sell a weekly and it goes against you, right, to where you're losing your shirt, then you have to buy it back. So all settlement has to be done at the close of trading on Friday in money, right? Now, if you and I write a call, if I sell a naked call at, you know, $250 on CONY, try and use some kind of a real world, and I get 50 cents. Well, if it's trading at 235 or 240 or 245 and it's getting to be near, you know, 4 p.m. Eastern time and the markets are going to close, then I don't have to do anything. I just know it's going to expire worthless, right? Well, in this flex marketplace, because they get some advantages in that they never get assigned the stock, that they have to buy it back, even when they're way in the money or out of the money and they don't have any risk, they have to buy it back. So sometimes you'll see them buy it back for a penny or 2 pennies or 3 pennies, because that's the way everything's settled. There's no just, oh, it expired worthless, right? But conversely, you and I in that market, if we sell a call, they can assign us any time if it goes way against us, because the counterparty, the person owning the other side, if we sold the call and they bought a call and it went way up in value, which meant a big loss for us, they can sell, and then the options marketplace said, oh, who did we assign the other side of that? Okay, you just got sold those shares at 250, right? And so that's a subtle difference, but it's absolutely required, because in order for this single stock fund to exist as an ETF, they cannot own over 10% of all the monies that they have in a single stock. And in this case, all they are into is the single stock, right? So how do you avoid owning 10% of it if your whole fund is around that stock? Well, you buy options, right? You don't own the underlying. So they found a way, a very creative way, with what they call these synthetics, that allows them to buy a call, which is always a bullish bet, sell a put, which is also a bullish bet. So if the stock goes down, they're going to be hurt. They're going to lose money on those synthetics, right? So selling a call in that environment, even if the stock just goes down a little bit, it's not going to go up the 5% that they sold that call for, so they're going to collect money. And so it's just an additional, you know, they refer to it as a covered call, but as I said many times here, it's not really a covered call, because a covered call implies that you own an underlying. But they're talking about, hey, I put this bullish bet on, right, with these synthetics, buy, call, sell, put, So I'm selling a naked call, and I'm referring to that action as a cover, right? A cover for my other position. So just to, give you some nuance. So the only thing here we are, right? So we closed at 225.78, right? And remember, the other thing about all options only have two components. They have the strike price, which dictates what is the value of that option at any given time, and the other is time, right? So as time moves closer to the expiration, the time premium dissipates, right? It just reduces. So if I go out here, and I'll go back on holdings, and I'll give you an example of that in just a second, and you can see where we are on those, right? Just like, let's go to holdings and do that. And then I can continue the education there a little bit. So where are we? You all know that this is just a way of looking at our cash. Our cash is up because 350,000 additional shares were sold today, right? So we got about $8 million in, and they didn't deploy it. And by going up just a hair, we moved up our gain on our synthetic, which is out on 719, from 18.1, I think, to 18.5, right? Or 18.073. I finally just updated these. This is still the number from the old 260, right? So I have to flip these around, but you always want to see it moving positive. So just to give you an idea of how this time premium works again, so this is a 220 put option. So when you sell that, you're bullish, okay? It was under 220 when they sold that, so if they collected 30, 40 bucks, whatever they collected, I could go over the synthetic and look. As we approach and we get closer and closer to 719, as long as we're at 220, that's going to end up at zero. So we're going to gain $52 million, right? That's against us right now. But conversely, we would lose 71 million if it went to zero. And the reason this number is bigger than this number is because we're gaining when we're 5 over. And 5 over 220 hurts us. If it was flipped around and trading at 215, this number becomes bigger than this number because your call bet really shrinks. And now you got $5 of value underneath 220 plus all the time premium. So hopefully I just keep pegging away and teaching you guys until I can get my video, because at some point it's going to be where I can't answer all of the amount of questions as my subscribers grow. And I'm just going to have to do 1 or 2 really detailed videos and then just refer people, right, to the video. Watch it, watch it, watch it. And then if you're not clear, just ask a question. So I'm not complaining. I love my subscribers. I love having the channel. I don't mind answering it. It just, I know I'll bump up against the time issue on that. Okay, so let's cover the key thing here to understand why we're being hurt, right? The yin and the yang. So if you write call options, these naked calls, the idea is to collect money. Well, when coin moves up too quickly, I say this a lot, then the value when we wrote it versus a few days later, okay, plus the time premium all work against us, right? Time premium hasn't had a chance to really go down to nothing. So like on this one, I think we sold it at $2 or $3, right? But this 230, right? So technically right now we're trading at 225, right? So we sold this thing at 104. Just track the, just, bear with me. We're going to track this one as an example, and then you're going to be able to apply the same logic to this really big one, right, at 222 that we're over by. Okay, so the 230, I think we sold it yesterday. Let's go look at our May tab. Okay. Yeah, we sold it yesterday on 520. We got $2.43, right? So I think, Steve, now you know and understand that's what we add to 230. That's our break even. So if it's 230 or under, we keep the 104,000. At 230, 243, we give back the 104. For every penny above 232.43, we start then paying them money besides giving them the 104 back. All right? So let's talk about where we're hurting, because honestly, that's not what is killing us, right? Let's go to holdings. Sorry, guys. Okay. So, but I track in here that if we had to buy that back, it's 245, right? And yet you say to yourself, I do, well, it's 230. I'm not worried. As long as we stay under 230, it's going to go to zero, which is absolutely true. So we got $4.20 of leeway, yet look at the price. It's 570. Because when we wrote that, we were probably at like 214, right? So going way out to 230, they were only going to give us $2.40, $2.43, right? So we collected 104. But now that thing is 570 because it's not that far away. You know, it's just a heart, you know, a heartbeat or two away from being at 230. Now, if it lands at 230, it's still zero. If it's 231, it's only $1, right? So again, the 232 becomes break even. But when you look, where are we hurting? This doesn't matter too much, although we're pretty far underneath. So look at this guy. We wrote 110 is what we collected, right? We probably sold it for a couple bucks. $3, $4. But we got to pay 421. So we got to pay 4 times the money based on right now. Okay, now there's some time premium in there, right? So if we end up closing, this would be a quiz to you guys, okay? So we wrote at 215. Right now it's got 1405. What would we have to pay in the buyback price, not how much money, but just in the buyback price, if it expired at 225 even at 4 p.m. on Friday? Okay, I want you guys to think about that. What would the price here be? And you say, well, I don't know how to calculate option. Yes, you do, if you use a little simple logic. There would be no time premium left. So what's the strike price? 215. What's the ending price? 225, right? 225 minus 215 in my book is 10 even, right? And we're trading at 225, so the actual price of this without the time premium is $10 and, you know, whatever our 225.78 or whatever the number is, right? So that tells you what the time premium for 3 trading days is. So now fast forward to this guy. This is 222.5, right? And let's go get our real number so I can walk you guys through this. Our real number closing is 225.78. So I had that number. Okay. So where do I want to be? I want to be back here in holding. So let's do a little math. Okay. So we're at 225. So we are $3.28 above that strike price right now. And they're saying if we bought it back at the close of the market today, when we were trading at 225.78, we would have to pay $9.60. That would cost us $21,500,000, right? They gave us 6.9. So that says to me we're going to lose 14 something million, right? Which is like 60 cents, 50 cents when we distribute it across the amount of shares that we have, right? It's more than half. At 11, we lose 50 cents, right? 11,375. So that, you know, you guys can start thinking. I don't expect you to be an expert in it, but if you just begin to realize, you know, this is, you know, options are sophisticated. Sometimes the strategies and how they get deployed, but once you sort of just, you know, get used to them, they're a bet, right? If you know, what do banks do when banks exist? So banks come out and they lend you money, right? What is interest? Well, it's the charge to borrow money, right? Well, your friend might. If you borrowed $10 from your friend, hey, I forgot my wallet today, and I don't have my credit card. Can I borrow $10 for lunch? Okay, here's 10. You pay him back the next day. He doesn't pull out his calculator. Hey, maybe there is a guy like that, right? But he doesn't pull out his calculator and tell him you owe him, the going rate, And but in the options market, that's what it is. Well, so different stocks with high IVs, which is an indication of the volatility, have higher time premiums. That's why MicroStrategy is off the chart. They can get $25 and be, 23% out a week later, right? They went to 1830 when the stock was trading at 1570 and they got $25 because their IV is sky high, because that thing can go from 1,000 to 1,800 in a month and a half, right? So when you start doing that, you earn your high IV, right? So you can be hurt either way if you're not careful. So anyway, that's how all this stuff works. So all I'm doing is applying my options knowledge, plugging in accounting values and reading the numbers to you, right? I try to do chart analysis. They talk to me, I can read them, but they don't always cooperate. I can tell you it's an 80% probability we're going to do this, and all that means is maybe 8 out of 10 times I'm correct, and I don't always know the time frame, right? And there's just so many things at play here. But it gives you better odds. Just the fact that you guys have found YieldMax, to me, the fact that these sophisticated options allow now retail people to go in. This used to be an institutional thing that only wealthy could have access to, right? Where you paid you had a multi-million dollar thing, and you were paying them 3% or 4% a year to manage your money, and they had a team doing something similar. So this is pretty cool, but the old rule, and then I'll just finish this, right? I don't want to, take all your time. The old adage is, know what you own. So at the end of the day, are you bullish on the underlying, right? Do you believe over the next few weeks, over the next few months, over the next period of time, as long as you want to own one of these funds, what you don't want to do is, in the Tesla people saw it. Tesla went up, 40 times its value at some run-up cycle, right? And then there was a period where it was just going to correct. And here you're buying this fund because it had an high IV. Of course it did, because it flew up and it flew down. So that keeps the IV up. And everybody say, well, I'm collecting my dividends. But you're collecting your dividends on a tremendously declining asset. So even though you're getting, so there's where total return. I always tell people, even somebody that says to me, I'm down $2, Bruce, on CONY. I've had it for 8 months, but the NAV's down. Is the NAV gonna, reverse split? Am I gonna lose all my money? Well, hell no, because probably if you've had it for 12 months, you've already paid for what you bought it for, just in your dividends, right? But once you get them, you think, I got them, and the stock's equal, or right? But ultimately, if you're not reinvesting them, unless you're in that real bull cycle, right? So that's what this is. That's why I say that YieldMax belongs in your portfolio, but shouldn't be your exclusive portfolio. So anyway, enough on all that. I've really gone long. So, but hopefully this was educational. So we set on an 18.5 win, right? But we got to buy this back. And in our money over in payments, we've already received $7 million. But just in fairness, if all we do is go to 222, if we stay at 226, okay, I know you guys can do that. So if we close at 226, what's this price here, right? So at 226, who knows where it's going to go anymore? I thought we were going to break out. We only came back to 225. I think the bulls favor the bears on whether it climbs, but the NVIDIA earnings and what that does to the market on risk on and up or down is probably going to dictate what happens after the close tomorrow. And if it runs, then crypto's probably going to run, gold's probably going to run, a lot of things are going to move. If inversely they don't like something that NVIDIA says, then and it sells off, maybe we get lucky and capture it, but we're going to lose over here. It's just, again, what I said to Steve, it's paper value, and I think to somebody else, but it's real, but it's not deposited, right? So I gave this analogy for all the rest of you that somebody knew. If I buy a stock and it's $10, right? And the stock goes to 14, okay, and I bought 1,000 shares. I want you guys to do the math in your head or think about it. So I bought the stock at 10, I bought 1,000 shares, so I spent 10,000. It's now 14, so what's that stock worth? I know a lot of you are saying 14,000. So you've made 4,000, but have you actually made the 4,000? You have a book profit, right? A paper profit of 4, because tomorrow, if you don't have a stop, you don't do anything else, and the CEO comes out and says the CFO was cooking the books and you know, doing bad things to us, and the stock drops to $6, then your $14,000, which is a 4,000 gain, you know, becomes worth 6,000, and you got a $4,000 loss, right? And then if you sell, it's a real loss. So that's all I ever mean. I know most of you know that, but you know, when I say it so many times, it's only a paper and this and that, people start to think, well, that's not real. Maybe only the weekly is real. No, the problem with the weeklies is they have to, by definition of it expiring, financially settle it. Either buy it back for pennies and keep all the money they got, or buy it back in the middle and keep portion of the money, or worst case, buy it back and lose a bunch of cash, right? So that's what I mean when I say book value. It's just like owning a stock and not selling it. And there's a lot of stable stocks that you own and you feel pretty comfortable that you've got that money even though it's vulnerable. Okay, let's go to payments and talk it all out here. All right, so what we need to happen in the best possible scenario is we get much closer back to this one. There's a chance of winning again, but these 700, they mean nothing when you got 22,000 here. So let's do one more scenario. So let's say it closes at 2226, right? That's 3.5 we could buy it back for. So let's plug that number in, right? It's easy. So I plug in 3.5 and just tell yourself, okay, my 21 million, right, drops to 7. Now, I lost my 6.9, but I didn't get quite as killed, right? Because I had to spend 7.8, so I lost 900,000 from what they gave me, okay? And these guys, this one you're going to win, right? So you're going to get your 104. This guy at 226, you're going to lose 11, but I could make this number 11, right? But I mean, so that tells me that I've got to spend 8 million with those new values, because this number, well, this number would be 0, right, if it closed at 226. So I got to spend 7.8 on the 7 I received. So again, education. So guess what? We've got a 7 million gain in here. This number becomes minus 13, right? Not minus 20, because remember, minuses are plus in this guy. You know, this is a loss, this is a gain. So the 91 cents is going to get reduced down, right, by the almost 8 million that we have to spend. So that's going to be like 12, right? Maybe 13, and then you got 7 there to 27. So I'll mess up all my spreadsheet if I plug it in. But you get the idea, right? It's going to be about 60 cents of this 91 cents. So then we drop down to 31 cents. So that's why I'm talking to you guys. Now, one of the things, here's 2 things they can do. They get to write new synthetics, or sorry, new weeklies on May 24, right? So we got another chance. And then they're going to write those again on May 31, right? So you got 2 more times to get 7 million. You know, they could go up to 8. So you got another chance. So all of a sudden, let me do something here. I'll add plus a minus. Let's go out and say 16 million. Right? So I'm being really generous, and assuming we don't lose it all this week, right? I kept the 20. I added 2 more weeks, and we're at $1.62, right? But we still got this loss over here, right? But we had a little bit of carryover. I think they paid us $2.28. So they could pay us on this kind of thing $2, $2.20, something. You know, they may only pay the $1.62. But all I'm saying is, but we would, here's one other tactic that they could do. So let's wipe this guy out. Keep my 20 million. This could get reduced, but not by enough to just wipe it all out. And it can't do it this week, because if we run too high, much above 225, we face a bigger loss here, right? But if you go and you look at that synthetic, right? So for the following weeks, let's say they get aggressive and it ends at 226 this week, and they ride a 240 for the call next week and do smaller amount of income, and it runs, you know. So as we start to move up, these numbers are going to get bigger. At some point before declaration, they can roll to a higher one, and when they roll, this becomes a sold number, right? But all I'm saying to you in the math is, when you go look at that, right, I'd have to say, okay, plus a minus 22 million, right? Did I get enough numbers? 22, 1, 2, 3, I need one more 0. I love doing this for you guys. So at just, you know, and if we can get this up to $1.50, I'm not sure we can win this week, but maybe we don't lose as much. We just give back. And remember, that would take us down to 41 cents, as I said, probably to 13, and then we get 2 more wins, okay? But if we can start reducing that by rolling, then, you know, there's more of a probability. So if I had to give you my best guess is, you know, luckily, if we got $2, it would be amazing this time around, okay? But a dollar seems assured, and nothing beyond that seems assured. But I believe that the NAV price is in a level that I don't see much downside on the NAV, right? People would just have to, you know, sell out or something. I don't see it dropping by much, and I'm really bullish. So if this happens, then they can start out, and if they don't roll that synthetic, then we're just going to keep on running, and we're going to, you know, capture 80 or 100 million in that synthetic from the 220. So it's an interesting scenario. I've gone way too long for you guys. Hopefully my loyal, if you guys get bored with it, just skip through. But play it back sometimes if you want to understand this. Okay, Bruce, I'm out. Again, this is not financial advice. I'm not a financial advisor. It's for fun and entertainment only. Okay, see you guys. Bye.